It's Wednesday the 30th, I'm FX Plu, and this is CurrencyTransfer.com's market update. The main headlines today are that the euro is lower as the Italian crisis deepens, sterling falls on no-deal Brexit concerns, and the dollar is reactive ahead of data this week. So the Italian crisis, this has dragged euro-dollar to fresh lows yesterday as the standoff between the failed coalition and the Italian president deepened. The interim PM that was appointed by the president was rejected by the coalition, who in turn called for some peaceful demonstrations from their supporters. So it's looking very much like Parliament will be dissolved, and fresh elections will therefore have to be called. Markets are naturally concerned. A barometer of their concern is shown in the Italian debt yields. The 2-year yield leapt yesterday from 0.84% all the way to 2.71%, and the 10-year yield moved to 3.19% as well. This actually represents the concern that the market is pricing in over an Italian default. So realistically, this is some way off, but interesting reaction that the market has had to the political issues. Euro-dollar fell to a new low. 115.10 was touched yesterday. That's the lowest that pair has traded since mid-July last year. And a fun fact for you, we've seen a 4.4% fall this month in euro-dollar. That in itself is the largest single monthly loss since January 2015. And what happened in January 2015, for all you historians out there, it's when the Swiss National Bank unpegged the Swiss franc from the euro and chaos ensued. In the UK, the potential for a no-deal Brexit has resurfaced. Markets were spooked when the spat between the Bank of England and the Treasury kicked off, fearing that the bank, in their reasonable nature, would only really get involved if there was a significant rise in the risk. Sterling yesterday rose close to 115 against the euro, driven by euro weakness more than anything, but it fell close to 132 against the dollar. We have obviously looming in the near-term future the proposals from the UK about the future relationship with the EU. Meanwhile, chief EU negotiator Michel Barnier has been bemoaning the lack of progress made since March. And meanwhile, behind all this, traders are bracing themselves and preparing for more bad news as and when this does break. Over in the US, the dollar is drifting ahead of data due this week. Today we've got GDP figures. It's a preliminary release, so it's unlikely to have a significant bearing on the dollar. And also politically, the US and China trade conflict flared up again yesterday with the White House threatening to impose about $50 billion worth of tariffs if China fail to do anything about a theft of intellectual property from a US firm. The dollar index was higher yesterday, driven by sterling and euro weakness, because they are the main focus at the moment. Towards the end of the week, of course, we've got non-farm Friday. Non-farm payrolls are due out this week, and the positive reading there could deliver a boost to the dollar. The downside risk does seem limited though, because given the volatility of that data set, a poor reading may well not see the dollar drive much lower. We will keep you posted. Just bear in mind what you're going to place your bet for non-farm Friday when we have the sweepstake.